Well, let's go ahead and get started. Thanks everybody for joining us today. We're really excited about a great panel, great topic. And thank you to everyone who is building a business or working with folks that are building businesses that make our communities a better place. The work that you do really matters. Building thriving communities is really important to us and to each of our panelists. And so we appreciate the work that you're doing. I hope that this topic is really helpful. As we're going along, if you have questions, feel free to use the raise your hand option here or drop something in the chat. I'll be monitoring for those and try to flag it down as we're going along. So I'll do some quick introductions of our panelists and then invite them to share a little bit more about themselves. We've got Cathy Mitchell, who does some really fantastic work with business valuation. She's one of the senior vice presidents over at AGH. Stephanie Siders, who's the managing director at CC Capital, working in investment banking. Nicole Phaneuf, who is one of the smarter attorneys here at our firm, and then myself. I'm one of the less smart attorneys at our firm. I'm trying to keep up with Nicole, and we're excited to be here with everyone. Cathy and Stephanie and Nicole, why don't you tell our guests a little bit more about yourselves and the work that you do to help folks increase the value of their businesses.
I'll get started. I've been a CPA for over 30 years, and the last 15, I've done business valuation almost solely for different purposes: transactions, estate planning, financing, and for litigation purposes. It's exciting because we calculate value as of a point in time, but there's so much planning that can be done with that value in order to grow the business. And I'm excited to talk about some of those ideas today.
Hi, I'm Stephanie Siders. As Sam mentioned, I'm with CC Capital Advisors. We are a lower middle market investment banking firm located in Kansas City. But we're regional, so we do a lot of work in the Wichita area up to Omaha, kind of within driving distance of Kansas City is where a lot of our transactions take place. So as I think about valuation and driving value, it's, we don't do a lot of formal valuation work as Cathy does, but it's more how can we think about...
There. Hey, Stephanie, can you repeat that last little bit there? I think we had a little bit of trouble with the internet connection.
Oh, shoot. Okay. Yes. I'm not sure where I left off, but we advise family-owned, founder-owned companies on M&A transactions. So when we think about value, it's really in terms of what do we think that it's going to look like from a buyer standpoint. What do we know from our experience in doing M&A transactions will drive value, and how do certain buyers look at various aspects of your company to think about what's important to them and what they may be willing to pay a premium for, or on the contrary, what's going to create less value and generate a discount. So I am looking forward to the discussion.
Terrific. And Nicole, why don't you tell our guests a little bit about the work that you do with folks?
Perfect. Okay. I'm Nicole. I work with Sam at Foreman Law. We are business M&A attorneys, and so we help create value by making sure everything on the legal side, documentation side, corporate level, employment stuff is all teed up in advance of a business sale. We also help identify, as Stephanie mentioned, where value might be lost. Ordinarily, that comes in the form of a seller who has all of the knowledge of the business that's not transferred into the business, that then can't be transferred on a sale, which loses value in the company. So identifying those items and creating avenues and mechanisms where we can make sure that that knowledge and that value is completely transferred in the sale to boost the value of the business.
Terrific. All right. It wouldn't be a complete presentation without some legal stuff. So just for everyone watching, there's no attorney-client relationship nor any CPA-client relationship created through this presentation. It is not legal or tax advice. It's solely for informational purposes only. I'll pause here for 45 minutes for questions. Just kidding. So we want to cover a couple of topics today. Start by thinking about, how do you define value? Value, it varies for each one of our clients, and it's not just money, although that's a significant role on most folks, scorecards and priorities, but there's more to it than that. We want to talk about who are you optimizing value for? Because somebody, as you look to transition your business, is going to determine whether or not the value that you've created is sufficient, and who is that person, and how does that factor into creating value. Then we want to talk about how that value is measured, and then spend most of our discussion today talking about ways to boost value, and then we'll have some more Q&A at the very end. So Cathy and Stephanie especially, why don't you talk to us about how the folks that you work with, how you help them define value, and what are some of the aspects of value that come into play?
I didn't know if you wanted to advance the slides, Sam.
Oh, I'm sorry.
And maybe they are advancing, but not on my screen.
They're not on mine, Cathy.
Give me just a second here. Let me try to get that.
They missed the benefit of reading the legal disclaimer for themselves.
Give me just a second here. Okay, so are you seeing the slides at all on your end?
Yeah.
It's on the panelist slide.
Okay. Is it on legal stuff now?
No.
No.
Okay.
It worked earlier.
Okay. Yeah, I'm not sure what's going on. Let me see here. Give me just a second. If you would just kind of talk about, we'd talked about previously some of the aspects like financial, family legacy, freedom and autonomy, community impact, and other types of value. If you all don't mind kind of addressing some of those, and I'll try to see if I can get the slide share working again here.
Cathy, do you want to go first?
Right. I'll let you go first, Stephanie, since I went first on the intros, if you like.
Yeah, no problem. So really, this is one of the first questions that we delve into when we're talking to clients and prospective clients is, to Sam's point, everyone has slightly different objectives, but our main goal is always, what is an ideal outcome for you? Because, you may be thinking about your employees first and foremost, or you may be thinking about, generational wealth for your family. And so understanding kind of what those priorities are and how we may be able to best find partners that can maximize what is most important is where we spend a lot of time. So for a lot of people, it's a blend of all of the things on this list. Certainly, few people, especially I would say here in our part of the country, focus solely on financial value. A lot of times there is, a deep kind of a sense of feeling like they do want to make sure that their employees are taken care of, and that, maybe an ESOP is something they need to explore, and perhaps there's value that can be brought into play there. But if you're maximizing financial wealth, then a lot of the other things on this list are going to fall into place. You're going to have more ability to put money into the community. You're going to have more wealth to pass on to your family. So I think a lot of these items tend to be very interrelated.
I think this is a really holistic look at value. From my perspective, which is typically preparing reports for the IRS, for the courts, or for banks, I'm focused more on the financial aspect of value, for typically looking at the fair market value, standard of value. But I definitely respect that, all of these impact value.
Yeah, I like what Stephanie said too about different items are valuable to different people in different circumstances. I mean, sometimes the lead item that is most valuable to someone on a deal is employee retention, and figuring out a way to ensure that through closing after a sale. It just depends on the classic attorney answers that always depends. And so we like to talk to clients about what's most important to them once they get to the deal process, and leading up to how they define value, what's most important for them, what's on their scorecard, what are the things that are wins for them. And so having a good understanding of that really helps to drive the process and through the life of the business, how you approach different items.
We say it depends a lot too.
For those who are taking notes, write that down. It depends. That will always be the answer.
You only know what you mean.
Wear T-shirts that say it depends. That'd be good. Okay, let's go on to the kind of the next slide. For those that are in the chat, have mentioned that you can manually kind of continue to advance the slides there. And so if you're not seeing the slides advance on your own, if you would just kind of use that down at the bottom of the screen, there should be some arrows to the left of the live button that'll allow you to kind of advance those on your end. So kind of our next topic is who are you optimizing value for? And we've got a list here of some of the different kinds of folks that we frequently see people optimizing value for. And so, Nicole, why don't you kick us off here on this one with just talking about what are some of the differences that you frequently see between, how, from an optimization standpoint, how people are looking at things and the different types of folks there.
Yeah. So there's, as you'll see on the list, a number of different ways and people to try and optimize value for. And that really depends on your business, the structure of your business, what is valuable to you as an end goal, and how you set up for that. I mean, the value can be for yourself. That's just being able to sell your business, whether your top priority is legacy and family transition. Say you have a family member that's going to be buying the business, that value might be optimized in a different way than it would be for a more strategic buyer or one of the other types of buyers listed on here. They all come with their own sets of difficulties, I would say. You get into different relationships and different dynamics depending on who you're optimizing value for, and those are all handled differently. They're all very important to account for as you go through the process and consider. So.
And Stephanie and Cathy, as you worked on, a variety of different transactions with various types of buyers, can you talk a little bit about how who you're optimizing value for changes over time for a lot of business owners? And so, they might be in one phase where they're thinking, hey, family succession's the path, and then they get to a place where they realize, hey, my kids, don't want to or can't take over the business, or they've been optimizing for themselves and their lifestyle and minimizing taxes, and then they start thinking about, hey, I want these financial statements to look really good for buyers. Can you talk a little bit about some of those topics?
You can go first, Cathy.
All right. I did want to point out that while I understand optimizing value, and we're all about pointing out the value drivers so the value can be grown, that our standards from evaluators' perspective require that we be an advocate for our value conclusion. You all can be advocates, for your client and for, increasing the value. I have to be an advocate for a defensible value, to either, the user, to the bank, to a court, to a judge, or, for the IRS, I have to defend the value. But when we're looking, on the other side to optimize or grow that value, which isn't always the purpose of evaluation, it typically is for the business owner. And so that he or she can sell the business or, get more financing or get investors, attract investors. So for all of these reasons, I mean, they're common, and it can change from day to day as they change their goals.
Yeah, and I would echo that, Kathy, and take it a step further that we are representing our clients, which are the business owners, in a sell side transaction. So if we are able to help them position the company right and make sure that it is in a really good spot, it's growing, margins are strong, they're getting a lot of cash flow, then that's going to be helpful for most of the other parties on this list too, because they're going to get the benefit of the proceeds from that transaction, which will have a good outcome. They may be rolling equity into the new entity or participating in the next investment with, say, a financial buyer. And so if the company's doing really well, it's growing, that financial buyer is going to be successful. The business owner is going to continue to have a piece of the investment, and they're going to get another opportunity to cash out later. That may help with any family that's involved as well. It can also be a great opportunity at exit for a business owner to look at the employees or the management team that have been really critical to the growth of the company and to getting the company to where it is, and allow them to potentially gift shares of the company or give them a special bonus at closing that allows them to pass on that value to people that have been really critical to their success. And I think lenders fall into that as well, where obviously the best outcome for a lending relationship is for that relationship to expand, for the loan size to grow, for more investment to be made in the company. And so, if you have a growing entity that is making the right investments, then they're going to benefit as well.
No, those are terrific thoughts. Let's head on to the next slide. We've got one question here real quickly from Holly. What are the main differences between a financial buyer and a strategic buyer? And then
so a financial buyer is really what they bring to the table primarily is going to be capital. In a lot of instances, they also bring operational experience and strength. But we most often, when we talk about financial buyers, we're referring to private equity firms, family offices, wealthy individuals potentially, who really what their main goal is to put capital to work and watch that investment grow. Whereas a strategic buyer is going to be a corporation, a larger company who is looking to grow via acquisition.
Okay. Holly, did that answer your question there? Perfect. All right. All right. So let's kind of move on to how value is measured. And there's a lot of content on here, but let's hit some of these high points here. Stephanie, do you want to kind of talk to us a little bit about EBITDA and some of those other measures on there, and then how you might look at those from an investment banking perspective, especially. And then after that, Cathy, can you kind of talk about what differences there might be as you're talking to folks from a kind of a formal valuation perspective as well?
Absolutely. So I'll stay on kind of the deal lane, knowing, of course, that if we're advising a company that's making an acquisition, we're going to go through a lot of the formal analysis that Cathy is going to go into detail on. But as a deal is evaluated for acquisition, and as we are looking to take a company to market, what we're going to focus really heavily on is EBITDA. So earnings before interest, taxes, depreciation, and amortization. And truly what the rationale behind using EBITDA is, it's a proxy for cash flow. It's an easy way to look at the income statement of a company and determine that, yes, there's going to maybe be some capital expenditures that come into play as well, but this is what we could expect the company to generate in free cash flow. So in the world of M&A, most deals, depending on the industry, but across most industries, deals are valued as a multiple of EBITDA. So it's a great way for buyers to kind of look at things the same way, to compare apples to apples, different companies that are in similar or comparable industries. And that's really, it can be frustrating for our clients sometimes who get really tired of us harping on EBITDA, but it is kind of the gold standard in the world of M&A. So that's kind of first and foremost where we focus our time, and especially if we're looking at well in advance of doing a transaction, how can we increase your EBITDA, especially as a percentage of revenue, and drives margins. So that's really margins. That's really. I'm getting a lot of echoing. I'm sorry.
It's so good. The point is that we needed to hear it twice.
Yeah, that must be it. So that, I would say the other things are certainly areas that we look at very strongly, especially, looking at revenue and EBITDA hand in hand, because the higher your EBITDA is as a percentage of revenue, the more valuable the company is. If you can increase that percentage, even better. Those are important things. And I would say assets, we don't value companies looking at assets necessarily, but it is important to look at a company and say, wow, they have been making the appropriate investments to drive future growth in the company. So it is important to have assets, especially depending on what your industry is. If it's a capital intensive business, a buyer's going to want to know that you have made the necessary investment in the company to continue on the growth trajectory that you are on.
From a valuation perspective, we use 3 approaches to value: market, income, and asset. And what Stephanie described is the market approach to valuation is typically a multiple of an earnings stream, usually EBITDA. And the reason valuators like to look at the valuation of a company from a couple of different approaches at least is we hope that you applying 2 different methods under a couple of approaches support each other. And under the income approach to valuation, Stephanie described a market approach. We look at discounted cash flow or capitalizing free cash flow as just another avenue with which to value the business and support our value. The third approach to valuation, asset, for the asset approach, is applicable to asset intensive companies or capital intensive companies, as Stephanie alluded to. And we always like to consider the asset approach, which is adjusting your assets to fair market value and deducting liabilities also adjusted to fair market value if necessary. Because, if the earnings of a company are depressed or erratic, possibly for asset intensive companies especially, the value of a company may be more under an asset approach than under a market or income approach. So we always like to consider that just in case.
And Nicole, I would just add that one thing on here is comparable M&A transactions. Our biggest challenge with that often is that most transactions don't report what the company sold for, what the EBITDA was. So it makes it kind of tricky. But if we have inside knowledge, perhaps we did a deal in this industry in the last year and we know, that EBITDA multiple was X, then we can kind of look at the company in question and say, we believe that you'll trade at a similar multiple. We can apply that to your EBITDA. So that's really at any given point in time, kind of the best way for us to look at value. It's just very challenging because the data is often not available.
Mm-hmm. Yep.
There is publicly traded data available, but we don't apply comparable publicly traded company data too often under the market approach. And it's simply because publicly traded companies are so much larger than the companies we typically value, and size matters. You know, publicly traded companies, in our experience, are just going to trade at higher multiples, and it's hard to size adjust that down to the size of the company we're looking at.
It becomes very subjective, doesn't it, Kathy? I mean, you can apply, you can come up with any discount that you want to in that case to make it come out to say what you want it to end up at.
Defending it, that's hard.
Exactly. And that's the challenge that you have.
Yep. Well, let's move on to kind of the next topic in terms of ways to boost value, and spend a good chunk of the rest of our time here. Cathy, why don't you talk to our audience here a little bit more about some of the ways that you've seen the steps that business owners have taken to influence the increase in value on their valuation.
All right. Valuation's a function of forward-looking cash flow, that EBITDA that Stephanie mentioned, risk, and growth. Those are the three factors. So anything a business owner can do to increase the growth of his or her company and cash flows in particular, and or reduce the risk, helps drive that value up, which is what everyone's typically wanting to do, unless the purpose of the valuation is for the IRS. Then it's typically people want to depress the value with discounts.
Yep.
Is the mechanism by which we depress the value defensibly for the IRS. But these are some ways in which value can be grown. Improving sales, of course, having a plan with which to do that, either by increasing your customer base. And that always helps drive value, because if you have more customers and less concentration, then your risk is reduced. So that's one of the ways in which increasing sales, and particularly your customer base, increases value. Long-term customer contracts, while we consider those, they're usually outs to those. They can always be canceled. So they're not as critical, but we look at them and the length of them and the history during which that customer has been one, and also if those contracts are transferable. Transitioning key relationships to team members, we always ask, if there's a succession plan in place, because with the succession plan, that means the management is deeper and broader. The management team is typically deeper and broader if there is a succession plan in place, and customer and vendor and employee relationships are starting to be transitioned to someone other than the owner of the company. That just makes the risk of the company less, and thereby increases value because of that risk reduction. So these are all great ways to increase value. What do you think, Stephanie?
Yeah, I would echo all of that. And I kind of look at these in terms of when we do initial outreach to market a company and are talking to potential buyers, I think about what are the first questions that they really want to talk about. And if I think about that, it is, what is the role of the business owner, and how dependent is the business on them being there day to day? Is the team overly dependent on them? Are customer relationships held by that person? So we've got that covered here. That can be critical, because if the business owner sells the company, the risk is, they ride off into the sunset, and what happens to the company at that time? Relatedly, I would say long-term customer contracts can be extremely valuable. On the next slide, we'll get into customer concentration, which is, I would say, key in that as well. But customer contracts can be really helpful to give a buyer just comfort that those customers are going to be there even post-close. Now, as Cathy mentioned, there can be some challenges with getting those contracts transferred, and there are outs, but buyers do love to see contracts in place. And then market risk, the one question that we oftentimes get, and especially as we have marketed companies in an economy that's been growing and growing and growing, is what happened the last time we had a recession? What happened in 2008 with this customer, or sorry, with this company? And the question is, how can they weather a risky economic environment? And so it's really important that you think about, well, what if there is a recession next year? How can you insulate your company from some of the economic turbulence that may come up? And then I think we've covered transitioning relationships, but it really can be key to have value spread across a management team and show that they are able to manage that company. They're able to manage customer relationships. No one person is more important than the rest of the team, and that everyone is kind of ingrained and really dedicated to the company and the success going forward.
No, those are terrific thoughts. Nicole, anything to add on this slide before we move on?
Yeah, I don't know particularly if I have anything additional except continuing to identify areas where value might be lost and then putting good plans and practices in place to mitigate those items as you operate your business and head towards some type of transition, constantly thinking, oh, well, what if this piece can't be transferred, and constantly thinking, how do I get all of this bucket of the things that are valuable in my business to someone else who's buying my company, and just continually mitigating areas where there might be a leak in your bucket.
Mm-hmm.
Yep. No, those are good thoughts. Let's cover some of these as well. Stephanie, why don't you kick us off on this one?
Absolutely. So that first one is really critical, increasing your breadth of products and services. The more diversified your product or service offering, the more valuable your company is going to be, because that probably means you're less dependent on not just one product, but maybe that diversifies your risk across end markets. I think there's a lot of capabilities that can be added to most companies, whether it be technology or maybe product development. Maybe that's where, as you're thinking about building value in your company, you really need to make an acquisition. Maybe there's a smaller company that has a capability that would be really great for your company and would be a nice fit with your other suite of services or products. And so an acquisition can be a great way to further diversify. That leads into the next one, obviously. I think when people think about acquisitions, it's really, they're thinking about just growth. And a lot of times it's to increase that breadth of products and services, but it also, what we've seen in recent years is acqui-hires. And, maybe you do have a hole in your management team or a skill in your workforce that's lacking. And a good way to solve that takes a lot less time than building it internally is to go out and find an acquisition that, maybe that employee base is excited to be part of a slightly larger organization. And I think as you think about doing that and some of the other items we've talked about, the margin expansion will happen. The company will become more profitable. You'll be growing more. You'll find more efficiencies if you have the right people in the right seats and they're focused on growth of the company. Then that margin expansion should kind of organically happen. But of course, you want to have an eye on efficiency and make sure that there's not ways that you can cut expenses or do things with less cost. And I think I've covered the other ones already just through technical skills of employees, but diversifying anything and everything is really key, whether it be your customer base, your supplier base. You don't ever want to be overly dependent on anything in your company, any person, any supplier, any customer, because that sets you up for a lot of risk that is probably unnecessary if you take the time to address that challenge. Anything to add, Cathy?
Oh, I would concur with everything you said. I would also touch on a couple of these in a different way. Like the first point, increasing the breadth of products and service offerings. On the other hand, if you have a losing product, meaning, you know, you track your product lines by divisions, perhaps in your financial statements, and it's dragging down your earnings, and you can quantify that, or you have a service line that's dragging down your earnings, you know, that you should consider stopping that line of business to increase your growth in every area and focus, you know, management time and the opportunity cost of, you know, a losing product line. I just valued a company that when they got rid of one of their divisions, the rest of their, and that was actually 2 years ago, but they've grown so much since then because they weren't wasting resources in hindsight on that division. So pay attention to products that may be losers as well. The identifying actionable acquisition opportunities, size matters. Don't you see multiples are higher, Stephanie, for larger revenue companies? All other things equal, margins being the same and everything else, a company with larger revenues is going to command higher multiples in the marketplace than a smaller company. Is that consistent with your what you see?
100%. Yes. Yeah, that size does matter. And I will tell you why we think that matters. And that is, as we look at the buyer universe, there's, and we do focus a lot on financial buyers, again, the private equity family office buyers. And there's a, you know, a bucket of buyers that is willing to buy smaller companies, say less than $3 million of EBITDA. There's a larger bucket willing to go 3 to 5 million. There's an even larger bucket, you know, 5 to 10. And so the buyer universe increases almost exponentially as you kind of move up in EBITDA. So it absolutely creates more competition, which generates higher value. They don't, one of those buyers isn't going to have to make 3 acquisitions to equal the 1 acquisition. They would much rather just do 1 larger acquisition. So that's kind of the rationale there. And I would also say on the identifying actionable acquisition opportunities, that's important not just to think about, you know, how can I improve my company today, but any buyer's going to want to know, you know, who would you acquire if money were no object? What makes the most sense for an acquisition strategy for your company? And if you've already got a list of companies, maybe one of them has a service that makes sense, one of them has a geography that you don't have, then they already have the playbook for moving forward with additional acquisitions. And for a lot of buyers, you know, money isn't really much of a problem. So it can be kind of a fun proposition for a business owner to think, well, gosh, you know, I would go out and buy all kinds of companies. So if there's a really good strategic rationale for those, then that's going to really pique the interest of a financial buyer whose main goal is to, you know, create a larger entity by way of acquisition.
The last item I wanted to touch on briefly was focus on expanding margins. Margins are simply EBITDA divided by sales, gross profit divided by sales, net income divided by sales. Those are examples of margins. And I would absolutely recommend that you start tracking those things internally in your companies and pay attention to the direction. And you want that to be positive. And if it's not, or it's declining, address what's causing those margins to decline, because you absolutely want expanding margins if you're trying to boost your value.
And again, the higher the profitability, and we look at EBITDA margins very closely, the higher that EBITDA margin, the bigger your buyer universe and the more interest your company is going to garner.
No, those are great thoughts. Nicole, anything to add, particularly as it may relate to kind of the timing of, putting some of these into place?
Yeah, I mean, the earlier the better. Get those processes in place as soon as you can identify that is a process to put in place before you enter the sale process, if that's what you're doing. Then you've got added time to kind of iron how those work out and make sure they're easily transferable to a buyer in the future.
Yeah, no, that's great. I mean, one of the things that always makes me a little bit sad is when somebody comes to the deal table and they don't have time. Like it is, hey, I've got a health diagnosis, I've got a family thing, my business is in a particular position, and they're just out of options. And so, the value creation parameters have already been kind of defined at that point. And so, being able to build your team, start thinking about some of these things and when to put them in place, the more time you have, the more bang you can get out of your buck for these. Let's go on to slide 11 here. And Stephanie, I know you talked about customer concentration earlier. Do you want to kind of kick us off there and touch on some of these things?
Yeah, absolutely. So customer concentration can be defined differently. I think, however, that buyers often have a very low tolerance for any customer concentration. So, and this is where it kind of goes hand in hand with those customer contracts, because especially if you don't have a contract with a very significant customer, you're really setting yourself up for a lot of risk. So we like to see less than 20% for any single customer. Ideally, you would have, less than 10%, maybe less than 5%. You'd have all kinds of different end markets and different services and products that you're offering. But really, the key is if you do have a customer that is really outsized for your company, then that can make it a very, very challenging process. That's an automatic no for a lot of buyers. So you're eliminating a lot of the buyer pool, which inherently means that you're not going to get as much value. So you may have a lot of cash flow, and for you as the business owner, you're comfortable with that customer being in place, and maybe you've had that relationship for a long time. But if you're looking at an exit, then that's going to be a major hurdle that we have to get over. So again, going back to Nicole's comments around timing, the quicker you can get in front of that and try to diversify your customer base, the better.
Yeah, just to kind of piggyback on that item, sometimes there are businesses with highly concentrated customer bases, and that's difficult to diversify sometimes. And so mitigating that by making sure you've got good relationships in place, you've got team members set up to continue those relationships, making sure you have good long-term agreements in place with those highly concentrated customers that are transferable upon a sale, will help transfer that value in the event that, I mean, that's always helpful to have with your customers, but particularly when you have a high customer concentration on a couple big customers.
Related to that, if you can, also diversify your industry in which your customers are. We value manufacturers all the time that their only industry is aerospace. And if they can broaden that industry of the industries of their customers, that helps reduce their risk as well.
Especially if it's a really cyclical industry like aerospace.
Or oil and gas.
Oil and gas, yes,
Yep.
Those are probably the two.
Yeah. No, I think those are such important thoughts, and being able to kind of zoom out and look at macro trends, which I think you had addressed a little bit ago, and being able to look at, okay, how does this industry, function, and then maybe finding one that has a different cycle that they may offset, so that you can provide some smoothing. Because certainly when a buyer digs into your numbers, if they get in and they see large peaks and valleys, the peaks aren't going to matter as much because of the valleys. and being able to smooth some of that out is going to give a buyer a higher level of confidence.
Agreed.
One quick note on smart tax planning, because who wants to pay the government more money? Show of hands. Nobody? Okay. Yeah. Is making sure that you've far enough in advance started to adjust your tax planning and you understand what is smart tax planning relative to what your desired exit strategy is, or what value you're optimizing for. Because, you know, doing optimizing for, you know, minimal tax burden for you and your current ownership is sometimes going to be at odds with, you know, optimizing the tax burden on an actual sale event to a third party.
I always
Especially-
like to say I'm not the IRS, but I do need to know the personal expenses that are being run through the company, if
Yes.
that's the case. Otherwise, I'm misvaluing the company.
Yeah, no, absolutely. All right, couple last thoughts here before we transition to questions. Nicole, why don't you kick us off on this one?
Yes, use good contracts. Period.
Spoken like an attorney.
Have a good team in place, have a good legal team in place that can provide you and review any contracts that you're entering into or providing other people, making sure again that those are transferable in a sale, making sure they address all of the things that they need to include. That's with customers, suppliers, that can be with employees. And just making sure you're keeping really good documentation of everything that's happening in your business, regardless of what that relates to. A couple of additional things: good corporate level documentation, keeping good minutes, having a good operating agreement in place or bylaws. That, of course, changes depending on the ownership structure, but those can be really important in place to provide a mechanism and an avenue to the transfer of the business on an internal level with the corporate owners. And then one other thing, ensuring legal and regulatory compliance on all items and being aware of industry regulations that you might be subject to, and just making sure that you're consulting with your attorney and your legal team to make sure that those compliance items are being followed and that those don't pop up and create issues for you later. And clean financials in
Yes.
capitals.
My favorite.
That'll be your bullet point number 2 for everyone. Clean financials.
Yes. Can't emphasize that enough. And and I think that really goes hand in hand with the bullet point before of having a good team of advisors, because your advisors should include, your accounting team, and it should include your wealth manager and, your attorneys and investment bankers. So everyone should be coordinating and on the same page. But we really can't emphasize enough how important it is that you have really good financials, you have good controls in place, that when we look at your financials, we are able to determine, this is a true and accurate picture of how your company has operated in the past. And also we want you to project your financials going forward, which no one wants to do. But it's important. And if you're in the routine of doing that forecasting, then it shouldn't be so difficult. But it is important for, again, I'm looking at this from the M&A perspective. It's important for potential buyers to be able to see, where's this going? And, because that's where they're going to take ownership. And I'm going to build on one of Cathy's comments as well. And it, I think, goes hand in hand with clean financials. It's okay if you're running personal things through your financials, but we need to know about it, and that needs to be called out. And so one of the most important things that you do in a transaction to boost value is to identify all those things that are either, maybe it's personal, maybe it's a one-time extraordinary expense that you had for, say, a consultant, or for something that was a one-time thing, never should have happened. It was an expense, never going to happen again. we want to add that back. We want to identify all those things that aren't part of the ordinary course of business of your company and add that back to your EBITDA. So the more that we can have candid conversations about what's really in your financials, the better we can make that EBITDA look, and the more transparent it's going to be to any potential buyer that's at the table.
And Stephanie's referring to what we call normalization adjustments to adjust the EBITDA, for example, to get rid of non-recurring, non-operating, discretionary, extraordinary income or expense items. And you get too many of those because your financials aren't clean, and it's hard for anyone to see where you started and where you ended because of all the normalizations in between. So clean financials help in that process.
No, those are all great thoughts, because at the end of the day, when any of us, here on the panel are looking at a business and trying to help our client make a great decision, whether it's preparing for a sale or looking at an acquisition, confidence plays such a role in it. We don't have certainty about the future, and so what we're left with is, confidence about what's likely to occur based on the information that we have. And so the more you can bring to the table that helps someone feel confident that they're going to be able to successfully transition the value that you as a business owner have, or that you're going to be able to obtain that from a seller, the more likely that transaction is going to be valuable. So let's have some Q&A. We've got 8 minutes. It was a great discussion. Thank you, everybody. What kind of questions do folks have? Let's see if I can manage the technology well enough to allow people to ask questions. Or they can drop them in the chat or raise a hand.
One thing Stephanie mentioned while you're looking at questions that I wanted to ask her about was she mentioned that she likes to have companies prepare projected financial statements, and those projected financial statements are clean, right? Because they're not projecting their personal expenses and those things. But the problem we sometimes have in relying upon projections is they're hope-based, not fact-based. And so do your buyers typically rely on those projections that may be hope-based?
Well, I would say it's usually fairly obvious if it's hope-based, because it has to be defensible. And
Okay.
so, if you don't have a bridge of how you get from A to B, then we're going to be your biggest critics probably, because we don't want to be associated with, just unicorns and rainbows. And I would say it goes the other way too. Oftentimes we have clients that are extremely conservative, and they're very nervous if they throw out this big number that they think they can achieve. Then what if it doesn't happen, and they're going to be caught between a rock and a hard place. So let's just project 2% growth next year when we've been growing through 5 to 10% the last 3 years. So we actually struggle with both of those scenarios depending on the client, and I think it's important to push them a little bit if they're overly conservative to go, but what do you really think you can do? And again, the word is defensible. Is it defensible both to the up and downside? Maybe there's a better case, maybe there's a worse case, but if we can explain how you're going to get to these projected financials, then that's how we can feel confident that someone's going to buy off on them.
Okay. Jared has a question. How do you value a distressed company that has a declining or negative EBITDA? It depends.
That's a hard one. Cathy, do you want to go first?
I can't wait to hear your perspective on this, because you would be looking at this company, Stephanie, to sell it. I actually am discussing one of those companies this afternoon. So I do get to address this. And, you know, if they don't have any projected sort of earning stream or EBITDA whatsoever, sometimes you're left with an asset approach, which is adjusting the assets to fair market value and reducing that value by debt. If, you know, they can't on the horizon see any year in which they're going to start, you know, breaking even or, you know, creating positive earning streams. What do you see, Stephanie?
Yeah, we get through that challenge in the M&A world sometimes by creative structuring of the deal. So maybe there's no cash that trades hands at closing, but perhaps if there is a hope that you know, that the company can be turned around, then the seller can share in that upside. So there's ways to do that with seller's notes, earnouts, you name it. Oftentimes in those situations, maybe there's IP that has value. Maybe there's value to only one buyer. And so it really is finding the right party that's going to assign some value to it, or, you know, in worst case, to your point, maybe it's just the liquidating the assets. Fortunately, we don't see that too often. And hopefully if there is a company that's in that situation, they have the wherewithal to get the company turned around and create some value.
I would say one thing we've seen pop up a little bit recently in those situations and others is trying to ask the question, what is the data that drives the results? And figure out, is there anything in that data that's going to tell you about whether or not that trend is going to continue? Because if it's a cycle problem and you've got a pipeline full of leads and they're quality leads, and you can show that, hey, based on our historical performance, we close these at this rate, you might be able to persuade somebody that, hey, we're about ready to turn the corner. And conversely, if there's no data, or if the data says, hey, we don't have anything in the pipeline, or what we have isn't any good, then that'll tell you even more about what's coming next after the historical numbers. Stephanie Stephanie in the audience had a question. Can you comment on what pricing multiples have done post-COVID and the pool of buyers now, especially given the current interest rate environment?
So what we saw during COVID was in 2021 and 2022, there was almost a frenzy of M&A activity. A lot of buyers chose to do very little due diligence. It got very competitive to get deals done. And so, they looked past a lot of things. And in a lot of cases, and the ensuing multiples show this, they overpaid. And so we saw multiples really spike in those years. And then subsequently in 23 and 24 really came down. And there was more of a flight to quality. And what we've seen is multiples are still really strong for those high quality companies that have done everything that we've talked about to drive value. It's those companies that still have some challenges to address, or maybe one challenge that they're not seeing multiples come back. And to that point, bank financing is a little more challenging. And of course, cost of capital has gone up as a result of interest rates, and that's always going to put pressure on valuations. But because there is so much money out there, and I'm talking about both private equity firms, there's more today than there was pre-COVID, as well as corporate buyers, everybody's got a lot of cash and they want to put that to work, but they're not willing to take the kind of risks that they were a few years ago in kind of going lax on due diligence, maybe buying something and hoping they can turn it around. And so there's a lot more rational thinking in the room.
Any last questions from our audience here? All right. Well, thank you. Thank you so much. John, you've got a question? Let's see here. I can unmute you. Hold on. There we go. There you go, John. I thought I had unmuted you. I've allowed your microphone. I cannot unmute
There we
you.
go. Sorry about that. You mentioned, I was trying to type it in really quickly, but you were getting ready to cut it out. So you mentioned clean financials. Does basis of accounting matter? And does it matter if you have audited or reviewed financials as opposed to just internals?
I would say from my standpoint, I'm sure Cathy would echo this. In my dream world, everyone has audited financials and they're all accrual based. Unfortunately, that is not the case. Does it matter? Yes. It makes our jobs a little bit more difficult. However, I would say if there's reviewed financials, then we usually have a fairly high level of confidence. A lot of buyers can look past cash basis accounting, but it may depend on the type of company. If they're doing very long projects, that gets a little bit tricky. But I think for the most part, if you're a larger company, say, 30, 40, 50 million in revenue, it's probably time to start thinking about doing an audit if you're considering a sale in the next few years, because it really does just increase the confidence in the numbers. And, you get much more of that in-depth knowledge also from your accountant who can really step in during the transaction process.
Thank you.
So yeah, that's my plug for AGH.
That's what I was hoping for. Stephanie.
I think
Any other-
audited financials also breed better internal accounting subsequently
Mhm.
by virtue of going through an audit and learning the gap procedures.
Yeah. You don't want your first audit to be the buyer's due diligence.
That's exactly right. And in a lot of cases, even for small deals, buyers are doing quality of earnings analysis, and which is almost like an audit. And so if you've never gone through that process before, it can be a little nerve-wracking.
Good stuff. Any additional questions, thoughts, folks? All right. Well, thank you to our panel for joining us today, and to our audience as well. Have a wonderful, wonderful rest of your week, and stay warm.
Thank
Thanks,
you,
everyone.
Sam.
Bye-bye.
Have a good day,
Thank
everyone.
you.